Time for the latest earnings outlook now with Research Director Shiraz Mian. So the first thing we want to do is run down the scorecard. Has earnings growth improved since the last time we spoke?
Yes, they have. As of this morning, we have 355 S&P 500 companies reported results. 145 are still coming. I have the complete scorecard here. As you can see, 76.1% of the index's total market capitalization has reported results. So you have as good a representative sample as you would get.
Okay.
Earnings growth is tracking 4.5%. Revenue growth is tracking 2.6% for these companies. The beat ratios, which is the fourth column here, 67.3% for earnings, 49% for revenues. The growth rates and the beat ratios in the aggregate are tracking better than what we have seen for these companies in Q2, as well as in the fourth quarter average. And I have proof of that as well for you.
I was going to say, we're talking about this on Halloween morning. You're not tricking me here.
No, I'm not. And you could see that the earnings growth, the 4.5% compares to 3.1% in Q2. Revenue growth, 2.9%. Compares to 1.5% in Q2. And the average is the four-quarter average running through the previous quarter. So it's the beat ratio. Similarly, the earnings beat ratio is tracking better than what we have seen. The revenue beat ratio is a bit on the weak side, particularly relative to Q2, but not by much. So overall, the takeaway that I'm taking from the results is that perhaps expectations had fallen more than they needed to.
That's interesting.
So we were talking at the start of the earnings season how sharply estimates for Q3 were falling as the quarter unfolded. And in retrospect, looking at the beat ratios and looking at the growth rates, the most reasonable conclusion is that those estimates cuts perhaps were a bit too sharp than they needed to be.
So when the dust all settles on Q3, what's it going to look like to you? A pretty decent season, good season, or so-so?
That's a tough one. The thing is that we haven't really seen much growth. So somebody looking at all these numbers that I'm showing here, 4.5% growth, 3.5% growth, 2% growth, it's not really good enough, particularly when somebody looks at it relative to a market that's making all-time highs on a day-to-day basis. So this is better performance relative to preseason expectations. This is better performance relative to what we have been seeing in the last few quarters. The overall level of corporate earnings is very high as well. In fact, I have a chart that shows the aggregate level of total earnings for the S&P 500. And as regular viewers know, Q2 was an all-time record, which broke the record we had set in Q1. And Q3 was believed to be, or was expected to be, below the Q2's level. But as you can see here, Q3 is on track to beat the record that we set in Q2. So the overall level of earnings in the aggregate remains very high. What is missing is growth. And as you know, expectations on the growth front for Q4 and beyond have been fairly elevated. Many of us, myself included, have been kind of throwing doubts at those expectations, but that's where we stand.
So growth is still a big issue. And at some point, it's going to become an issue for the stock market, right?
It is. And that's the key question that we have consistently been seeing estimates coming down quarter after quarter. Companies beating current quarter estimates but guiding lower. We've seen that movie play out quarter after quarter for the last 4 to 6 quarters. The same has been the case in Q3 as well, as more than 2/3 of these companies beat. Many of them, perhaps about the same ratio as we have been seeing over Q2 and the last few quarters, are guiding lower. And we are seeing that in the estimates for Q4, which have started coming down. And I have
what's guidance telling you about Q4?
Q4 right now it's expected to be. Here it is. So the current expectation for total earnings growth in Q4 is 8.4%. As you can see in this chart, this is down from 11.7%.
So some of those reservations you had earlier in the year are beginning
starting to show up.
Play out now.
Are starting to show up. The question that many of us have struggled with is, why doesn't the stock market care? Right. And my theory on that front has been that it's all because of the Fed. As long as the Fed keeps pumping these enormous amounts into the stock market, not the stock market, but in the economy, then the investors in the stock market don't really need to pay as much attention to fundamentals, particularly earnings, and that's what we have been seeing. Once the taper starts, once the Fed shifts course, then my view is that they will need to pay more attention to the growth picture, and that may be the time when the rally pauses.
Okay, thanks for that. Keep up with Shiraz's written comments and his thoughts and even change of thoughts about the way earnings season's going. In 2 places on Zacks.com, in his earnings trends written commentary, which you can link to right off the homepage. In his earnings preview section, every Monday he has an earnings preview that kind of highlights what he sees coming up earnings-wise for the week. And actually 3 places. The third place, the day-to-day changes in his thinking, if there is any, in his Ahead of Wall Street column. All on Zacks.com, all there for your review. With Shiraz, I'm Terry Ruffalo.